Good morning, friends. Today we will continue with stockholders' equity, which we started in the last session. In the very first session of stockholders' equity, we had done what comes under stockholders' equity. Basically, it is the shareholders' fund. So we have the share capital. We have additional paid-in capital, that is securities premium. We have retained earnings, the amount of profit which the corporation has earned, net of dividend paid, if any. We have accumulated other comprehensive income, right? And there are few more adjustments which we will deal today, right? We had learned as of now what is the journal entry we do at the time of issuance of a common stock, preferred stock. We have also learned what are the different types of preferred stock. They are cumulative, participating, callable, redeemable, right? We had also done dividend distribution in case of different type of preferred stock. So today we will do few more journal entries associated with common stock, right? Now, suppose the company is having a huge surplus cash reserve and the company is unable to invest in some profitable ventures, means there is a saturation point, right? Company doesn't have any alternative use of those funds. Then in that case the company might return the money back to the common stockholders, right? So this is known as buyback. So this is buyback of common stock, amount money returned to common stockholders when company has no alternate use of money. Basically, it was kept idle. Now you cannot keep shareholders fund idle, because our ultimate objective is to maximize the wealth of the stockholders, right? So if you don't find any alternative use of the money, in that case you should repurchase those shares, some shares, not all the shares, because there has to be some equity, right? As per the SOX Act, there are some restrictions on the repurchase of common stock. You cannot purchase the entire common stock from the stockholders, right? You can just go for the part repayment strategy, right? So basically at the time of issue we credited the common stock and we credited a additional paid in capital. So it's quite common when you return them the money, when you repurchase common stock, so the common stock will now be debited and additional paid in capital will also be debited. So the very first point which you need to note at the time of repurchase and retirement, you need to debit common stock and additional paid in capital, and obviously you need to credit cash, right? So the common journal entry is common stock debit at par value, then additional paid in capital debit, the excess over par value, credit cash, amount repaid, right? Now basically you need to compare your repurchase price with the original issue price, right? So this is my original issue price. Suppose $10 was the par value and I issued at 5, so 5 was credited to additional paid in capital. So now at the time of repurchase 5 is debited, so total debit is 15, and I have repurchased it for say 13. So if my repurchase price is less than the original issue price, then the difference will be again gain, right? Initially I collected 15, now I am repaying back 13, so it is showing me gain. So this gain will go to additional paid in capital retired stock, additional paid in capital retired stock, right? Additional paid in capital credit to right? So this is very, very easy. This is very easy. You don't have to worry about, right? What if your repurchase price is more than the original issue price? Then in that case, you have a loss. Initially you collected 15, now you are repaying 17, 18. So in that case, you will be having a loss on repurchase. So such loss will be first debited to additional paid in capital retired stock, if any, already existing in the balance sheet. And if you don't have anything, then in that case your retained earnings will be the balancing figure, right? So let us quickly see. Suppose company issued 10,000 common stock at the rate $14 bracket $10 par value in 2019. Now when the company issued, what entry I'll pass? Cash debit 10,000 into 14, that comes to 1,40,000. Then common stock credit 10,000 into 10, that is 1 lakh. Additional paid in capital common stock, we have 10,000 into 4, right? So this was the issue entry. Company repurchased and retired 500 common stock at the rate $13. Now out here you can easily see that repurchase price is less than the original issue price. So here I have a gain. Here I have a gain, right? In this case we have a gain. So now so at the time of issue you credited it, now you are going to debit it. So common stock debit 500 into 10, which is the par value. Additional paid in capital debit 500 into 4, right? So the amount it was credited to common stock and additional paid in capital, we have debited it, right? So now we are going to credit cash, that is 500 into 13. So there's a gain of 1 rupee which will be transferred to additional paid in capital retired stock 500. This is very easy, no need to think much. Now again, company repurchased and retired 200 common stock at the rate 16. Now out here you can easily see that repurchase price is more than original issue price. So here it's a kind of loss. Now already previously you had a gain which you transferred to additional paid in capital retired stock, right? So to that extent, we will debit additional paid in capital retired stock, and remaining, if any, will be debited to retained earning. Okay. So again, common stock debit 200 into 10. The original issue price will be debited 200 into 4. Cash, how much you paid? 200 into 16, that's 3200. Now you can easily see that 2800 is the repurchase price, sorry, 3200 is the amount paid repurchase price, and 2800 is the original issue price, right? So we have a loss of 2. 16 is greater than 14, so loss is 2. So 2 into 200 is 400. Fine, no problem. So you have 500 credit in additional paid in capital retired stock. So you will debit 400, no problem. Company repurchased and retired 100 common stock at the rate 17. Again, this is same. Repurchase price is more than the original price. So common stock debit 100 into 7, 100 into 10. The par value. Additional paid in capital amount credited was 4. So we debit here 4. How much are we paying? 1700. So now you can see that the total loss is 300. We can easily see that the total loss is 300, right? We can easily make out that the total loss is 300. So now what will happen? In additional paid in capital retired stock, we have 100 balance left. So first we will use that. We have 100 left, and balance, if any, will be taken out from retained earnings. This is the balancing figure, the plug. Right. So you need to note repurchase and retirement means buyback. When company has huge surplus cash reserve and company do not find any alternative use of money, you need to note shareholders ultimate, the company's ultimate goal is to maximize the wealth of the shareholder. So you cannot keep money idle. So if you don't have any alternative use of money, repay back to the common stockholder. Obviously you cannot repay back the whole amount because you need to have some equity, and as per SOX Act, there are some guidelines related to these repurchase and retirement, that up to this much only. Like in India, we have Companies Act 2013, which says ki maximum buyback can be up to 10% of the outstanding shares. Maximum amount that can be paid on buyback is 25% of the paid up capital plus retained earnings. There are a lot of restrictions when you go for buyback of shares. Similarly, for US entities also, there might be some kind of restrictions which is imposed by the US law, right? So this is how the accounting entry is to be dealt in. Whatever amount you credited at the time of issue, you need to debit that first. So the amount credited was 10 to the common stock capital, and 4 was the security premium. So you repurchase at a more price, less price, it doesn't matter. First of all, you are going to debit that common stock and additional paid in capital with the original issue price. Credit the amount paid. Now the difference is gains. You create additional paid in capital retired stock, and if it is a loss, then if you already have additional paid in capital retired stock, so you use that. If you don't have, then you straight away use retained earnings, right? So this is quite simple, right? And in our notes also it has been explained, so you can go through with that, no problem, right? Okay. Next, our topic of discussion is authorized, issued and outstanding stock. Now, what is this authorized stock? This is the legal capital, we can say, and in my opinion, this is the maximum amount which the company can raise funds through stock, right? Now you need to get the company registered first, right? Company is an artificial judicial body. You need to register with the registering authority, right? In India we have ROC, Registrar of Companies. It is handled by Ministry of Finance. So in US also there might be some registrar authorities who will be registering the company. So you need to tell your authorized amount, that how much amount you are willing to raise from the market, right? So this is the legal capital. This is the maximum amount which the company can raise from the market through issue of stock. Now what is this authorized and issued? Out of authorized stock, issued stock represents amount issued for raising funds. Means the number of shares you have issued for raising funds, right? Suppose my legal capital is say 1 crore. So it is not necessary that I issue the entire 1 crore stock at the beginning. I might go for 40 lakhs initially and balance 60 lakh I might go later on, right? Now if I get exhausted with the authorized capital, I can increase it by requesting the registering authority, right? So and next thing is what is authorized, issued and outstanding, right? So there might be a case that you might have repurchased some of your stock and retired, so that one will be subtracted, right? So this is net of shares repurchased, right? So this is the balance sheet total. This is balance sheet total. This comes under the balance sheet. When we talk about stockholder equity, this is the total which forms part. Forms part of balance sheet total. Right? So authorized capital means the amount, the maximum amount the company can raise. Out of the authorized stock, issued stock represents amount issued for raising funds as of now, and outstanding means net of repurchase stock. Now what is treasury stock? Treasury stock and stock repurchased and retired basically means out here shares are repurchased but not yet retired. Now if I retire a stock, means if I do buyback, it is permanently cancelled, but if I repurchase and simply hold it, so there might be a case whenever I require funds, I can again reissue it in the market, right? So treasury stock means share repurchase but not yet retired. This is very important. And retirement means you cancelled it off. You just destroyed the share certificate, right? Out here the share certificate is with the treasurer of the corporation, the company, right? The company is the legal owner now. So automatically, when the shares are repurchased but not yet retired, it means treasury stock. So in case of treasury stock, the number of outstanding will decrease, because I told you, even if you retire or you don't retire, your outstanding stock will reduce, right? If you retire it, if you buy back, then in that case it is permanently, the number of outstanding stocks is permanently reducing, right? And in case of treasury, for the time being the outstanding number of shares has reduced, but if the company feels like company wants to again have more funds for some purpose, the company can again float its treasury stock into the market, right? So if you have treasury stock, there might be a case, it might again go to the issued category, right? So right now, if in case of treasury stock, the outstanding stock is only temporarily reduced. Until that time, till that time you don't get any dividend, because the company is the legal owner. Company cannot pay dividend to him, right? I cannot pay dividend to myself, right? Similarly, the company cannot pay dividend to company itself, right? There will be no voting rights, because the number of outstanding stocks has reduced. So in case of stock repurchase but not yet retired, that is treasury stock, there are few points which you need to note. Number one, it reduces the number of stock outstanding, right? No dividends are paid till the stock is held as a treasury with the corporation. There are no voting rights, as I am the legal owner, right? No stock dividends, means no bonus shares. Stock dividend means bonus shares, right? Now when you do accounting entry for treasury stock, there are two methods. One is the cost method, right? And another is the par value method. So first we will deal with the cost method. So two methods. We have cost method. We have now under both the things, total stockholders equity remains the same. There's no change in total stockholder equity. However, there are different components of stockholder equity, like capital stock, additional paid in capital, retained earning, right? So and minus treasury stock, right? It reduces the number of shares outstanding. So only the components which are there in stockholders equity, that changes, right? But ultimately the total stockholders equity remains the same. So we will see it with the help of an example, so that it gives you more better clarity, right? Now in case of cost method, right, in case of cost method, it is said that cost in, cost out. Whenever you purchase any stock, right, whenever you purchase any stock, so you show it at cost. Whenever you again resell it in the market, you just outflow is shown at that price itself, right? And in case of retirement, you need to debit common stock and additional paid in capital. I'll explain you, no worry, right? So out here you can see that the treasury stock reported separately on a balance sheet, that is the deduction to the stockholders equity, right? That's contra equity. Now this type of method is only intended when the company plans to resell the shares, right? Means company is holding this treasury for the time being, not see, one thing you need to note, there might be a case, I have repurchased it, but I might retire after some point of time, right? So in that case, you go for the par value method. And if you have repurchased for the time being and you might reissue it later on, so in that case you can go for the cost method, right? So let us do with the help of an example, it will help you. So now we are dealing with treasury stock cost method. Company issued 10,000 common stock at the rate 15.10 par value. Right. So now this is the normal issue entry. So we have cash debit 10,000 into 15, that's $1,50,000. Par value will be credited to common stock and additional paid in capital will be credited with 5. Right. Repurchased 1,000 common stock at the rate 12. Now we haven't retired it, otherwise we would have compared the repurchase price with the original issue price, right? So only repurchased, you'll write here not yet retired. So it is cost method, right? Just like investment. If I don't purchase my own company ka stock from the market, if I purchase say Reliance stock or any company stock, then I debit investment and credit cash, right? Similarly out here we are going to debit treasury stock. It is just treated like investment, right? 1,000 into 12, that comes to $12,000, and credit cash $12,000. Just treat like investment. Treat like investment. Simply treat it like investment. Now if I resell, now I'm reselling it at say 13. So simply sale of investment. First of all, I will get cash 200 into 13, that comes to 2,600, and this investment will be credited at cost. This was the cost price. This is cost. So out will also be at cost. Right. So it is dollar 2400. Difference is gain. So it is additional paid in capital treasury stock. Right. Resell 300 common stock at the rate 11. So now when you are reselling, you are getting cash how much? 300 into 11. Treasury stock I need to show at cost. Now the difference indicates loss because I purchased for 12 and I have resold for 11. This is gain. So already I have gain in my books. Same as retirement. So whatever loss you have at the time of resale, you will first debit additional paid in capital treasury stock. So you have 200. And for balance, you will do retained earning. Now suppose I have retired 100 common stock. So when I have retired 100 common stock means now at the time of retirement I will debit common stock and additional paid in capital common stock with the original issue price. Now I will compare repurchase price versus original issue price. So repurchase was done at 12, original issue price was 15. So anyway, first I will debit common stock with par value, additional paid in capital with the excess above par value. Now I am not paying now, but I have already paid, which I have debited to treasury stock 12. So additional paid in capital treasury stock will increase.
सर एक बार और एक्सप्लेन कर दीजिए.
This is same as retirement. This portion is same as retirement. Whenever you are retiring shares, you need to compare the repurchase price with the original issue price. In case of normal, अगर आपने डायरेक्टली रीपरचेस करके कैंसिल किया है इमीडिएटली, तो ये आपका ओरिजिनल इश्यू प्राइस है. इमीडिएटली रिटायर कर रहा है तो पहले ओरिजिनल इश्यू प्राइस डेबिट होगा. इमीडिएटली रिटायर कर रहा है, ओरिजिनल इश्यू प्राइस डेबिट होगा. इमीडिएटली रिटायर कर रहा है, ओरिजिनल प्राइस डेबिट होगा. रीपरचेस प्राइस के साथ कंपेयर करो. रीपरचेस सस्ते में हुआ है तो गेन दिखाएंगे. गेन कहां जाएगा? एडिशनल पेड इन कैपिटल. एक नया से खोलेंगे एडिशनल पेड इन कैपिटल रिटायर्ड स्टॉक. लॉस हुआ तो एडिशनल पेड इन कैपिटल रिटायर्ड स्टॉक को डेबिट करो, और अगर एडिशनल पेड इन कैपिटल रिटायर्ड स्टॉक नहीं है तो रिटर्न अर्निंग को डेबिट करो. डन. ये इमीडिएटली रीपरचेज एंड रिटायर्ड. इधर में क्या हो रहा है? रीपरचेस किया, राइट? यू रीपरचेस्ड and you haven't retired as of now. You are holding it with your treasury. However, it will reduce your number of shares outstanding. In case shares repurchase immediately retired, share repurchase immediately retired, number of outstanding share anyway will decrease because common stock is debited, additional paid in capital is also debited. Out here, number of outstanding common stock is anyway decreasing, but here number of outstanding stock will decrease, but we haven't retired it permanently. We might resell it again. So in cost method, simply treat it like investment. This is purely investment debit to cash. If I am selling investment at profit, gain is getting credited to additional paid in capital, treasury stock. If I am selling it at loss, this gain is again getting debited, and balancing figure, if any, retained earning is getting debited. This 2, 3, 4 of cost method is just like investment. Investment debit at cost, credit at cost, difference is gain loss. But now if I am retiring, so again the original price will be debited. Credit investment with amount paid. Difference is gain. Is it fine? Now, if I prepare balance sheet after this entry, just after this entry, if I prepare balance sheet, if I make stockholders equity, then common stock will be $1 lakh. Additional paid in capital will be $50. Total is 1,50,000. This is total paid up capital. Less treasury stock. Less treasury stock. This is stockholders equity. Is it okay, everyone? After adding everything, last we will less treasury stock. If you see carefully, in my first lecture I have already shown you how this stockholders equity is calculated. Minus treasury stock under cost method. Right? Now, suppose after reselling this 200, again if I go for stockholders equity, say for example, right? We have additional paid in capital treasury stock 200. Can you just do the subtraction once?
Sir, 140,600.
So after every entry you can just change the stockholders equity. Okay. Now if I go by par value method, so this is cash debit $150, common stock credit right. Now par value method says treasury stock will be debited with par value. In cost method it was debited with repurchase price, but out here it will be with par value. Additional paid in capital will also be debited, just like retirement. Debit with original price at the time of repurchase. We haven't debited at the time of retirement directly, we cancel it. So we debit common stock, but out here we are not debiting common stock. We are treating purchase of our own stock at par value. Difference will be cash. So initially we are showing a gain. Initially we are showing a gain. When I talk about common stock, treasury stock will reduce directly. Out here no need to reduce separately treasury stock because common stock is getting reduced, APIC is also getting reduced. So now you can see we have 1,38,000. I told you na, Stockholders equity under both the options will be same. Clear? Resell 200 common stock at the rate 13. Treasury stock was debited with par value, so we are going to credit with par value. Additional paid in capital treasury stock. Compare with par value. Forget about cost. If I go for stockholders equity now, treasury stock it will be additional paid in capital see we had 14600. The total stockholders equity will remain the same. See, one thing you need to note in US-CPA exams, you need to practice, practice and practice. Without practice, you won't be able to crack exams, right? I've explained you the moment you practice more and more and more and more and more, when you go to one thing repeated times, it gets easier for you to understand. Treasury stock is at par value. So out here 300 will be gain, which will go to additional paid in capital treasury stock. Now additional paid in capital is already debited at the time of repurchase, right? So the only journal entry will be now common stock debit So now I'll show you one summary. Repurchase. Show at cost. Show at par value. Debit additional paid in capital, common stock, and transfer gain loss on repurchase to additional paid in capital treasury stock. Resell. Gain loss additional paid in capital treasury stock over purchase price. Out here, gain loss additional paid in capital treasury stock over par value. I guess this is absolutely fine. Now we can see that This I have explained. This I have explained. Okay. So this we have covered. Treasury stock we have done. Similar sort of adjustment has been dealt in here. You can just have a look. Now treatment of dividend. It's very simple. I have already told you, you reduce return earning and show dividend payable as a liability only when we declare it, not at the time of dividend when the dividend is proposed, right? So the important dates associated with the dividend that you need to note. Simply, first of all, the treatment is you reduce your return earning and show dividend payable as liability on the date of declaration when it has been declared, right? Now record date is the date on which the shareholders who are entitled is identified, right? Shareholder on this date is identified who will receive the dividend. So and this time there will be no journal entry because there is no outflow of resources taking place. Only the shareholders has been identified as of now. Now when the dividend is paid, simple liability payment entry, that's dividend payable to cash. Okay, chalo. Now instead of paying dividend in cash, you can pay property dividend, right? So simply treat it as like cash dividend. Treat like cash dividend. Record it at fair value on declaration date. And whatever is the difference, that I will record it as gain or loss. So 12/1 it is declared and December 15th it is paid. So we need to consider fair value as at declaration date. First revalue this. Show at fair value. And then we will show dividend payable at fair value. Because this is the amount of dividend we are going to give. So now when you are showing gain, so there is a gain of 200 that goes to return earning, and dividend due to dividend return earning decreases by 700. So net effect to return earning is decreased by 500. Now simply you just like you're paying cash dividend, you can give dividend and distribute land. Now liquidating dividend, basically we are returning capital, return of capital to common stockholder after paying all liabilities and preferred stockholders. So you are paying 15,000. Now you had 10,000 retained earning balance. So to the extent you have accumulated reserves in your balance sheet, to that extent it will be regarded as dividend payable, and balance will be regarded as return of capital. So which will be debited to additional paid in capital. I gave 15,000 dividend. Okay. Scrip dividend is like promise to stockholders for payment in the future, not now. Basically, normally when you declare dividend, you pay it within a month, right? Like in Indian Companies Act, there's a provision that within 30 days from the date of declaration you have to pay dividend. But scrip dividend is like I'm appropriating right now, but I'll pay you later. So when the question of later comes, obviously interest will also come, right? So when you are making the payment, so you have to pay the dividend as well as the interest along with it, right? So simply anyway we are reducing return earning and showing dividend payable as liability, and upon payment liability debit, cash credit. Simple. Stock dividend is like bonus shares. Issue of common stock to shareholders without consideration. You're not taking anything from them. Basically what happens, suppose a company has earned profit, right, and the profit is not in the form of cash. Maybe you have sold the goods on credit, maybe you might have bought some non-current assets. So whatever profit it is showing in your books, it may not be readily available for distribution of dividend. So in that case the company can go for stock dividend. Instead of giving you dividend in cash, company can increase your number of holdings, right? So additional stock issued to existing common without with no distribution of entities cash and assets, right? However, their percentage of holding will remain the same, the number of shares will increase, right? Because everyone will get bonus shares, right? So basically it's a capitalization of profit. We call it as capitalization of profits. So out here what will happen, your retained earnings will decrease and common stock will increase. This is what it happens. So now you can see it is a transfer from retained earning to common stock. Obviously, if I'm doing it at market value, so there will be some additional paid in capital as well. However, the total stockholders' equity will remain the same due to bonus shares. And the recipient does not pass any enter because he has got it free of cost. It will be simply increase in the number of investments he has. So now the company has 1 lakh outstanding shares of 10 par value. I'm giving stock dividend of 5,000 shares, means 5,000 bonus shares. So it is usually less than 20 to 25%. So what I will do, I will reduce my retained earning by 5,000 into 15, right? And increase the common stock and additional paid in capital. So my retained earning is reducing by 5,000 into $15. That comes to $75,000. It will be 5,000 into $10. That is $50,000. And this will be 5,000 into 5. That comes to $25,000. See, all these are components of stockholders' equity. So total stockholder equity will remain the same. So this is ordinary and this is stock split. So when it is more than 20-25%, then in that case you simply reduce your retained earning with the par value, not with the fair value, right? This is what it happened. Large stock dividend, right? Sort of 10 lakh shares issued, you are giving 40% stock dividend, means 4 lakh bonus shares. The company was selling at 20, par value is 10. So had it been small dividends, small stock dividend, then in that case I would have debited retained earning with 20, credited common stock with 10 and additional paid in capital with 10. But in this case, this is large stock dividend, so I am reducing my retained earning by 4 lakh into $10. That is 40 lakh. And common stock also 40 lakh. Only at par value. So stock split means increasing the number of shares. Suppose one share price is $20,000. One share is equals to $20,000. Now it is very difficult for a retail investor to buy a $20,000 stock. So that stock particularly becomes non-tradable in the market. So what the company does, it was 10 par value stock, right? Company has reduced it to 2 par value stock. So 10 par value stock का market value was $20,000. Now 2 par value का market value will be $4,000. Just splitting it into 5:1. Each share is got split into 5. So automatically the total capitalization value or the total book value, the total stockholders value will remain the same. Only the number of shares will increase and decrease. So stock split and reverse stock split is consolidation. we need to consolidate, right? So in India, stock split ko we call it a chutta karana. You have a $500 note and you want to have exchange. So you got $100 into 5 notes, right? Simply. So there is no journal entry, only the number of shares will increase, right? Okay. So that's it from the today's session. In the next session, we will come across with some new topics, right? So please practice questions from our content given, right? Thank you so much.